Hey, how's it going, everybody? Today I want to share with you some really great high yield ETFs that can be wonderful alternatives to owning real estate, particularly if you've bought that real estate in the last several years at the very high prices, or if you're thinking about buying real estate here in California. Now, we've been kind of trapped in a really difficult and challenging time for quite a while now, in that because interest rates were so low for so long, it really pushed the prices up of real estate and asset prices in general. And so unfortunately, people were buying properties that had very little income yield. Now, if you're somebody who's looking for long-term capital appreciation and you're not concerned with having regular cash flow come in, maybe you're a high income earner or something like that, then this probably won't make that much sense for you. But if you're somebody who invested in real estate or wants to invest in real estate to generate consistent cash flow, this is going to be just for you, so definitely stick around. Now, before I jump in and show you some of these opportunities, I want to give you a little bit of background on why I think this is so important. Now, I've been a real estate broker here in Los Angeles for about 11 years now, and for a great deal of that time, pretty much everything that you could buy was extremely expensive in comparison to the cash flow that it generated. Now, interestingly, all other assets were very expensive as well. So it wasn't like you could buy a government bond or some other asset that had a high dividend yield. And that's why a lot of people poured into real estate, even though the cap rates or the returns that you were expected to get on your investment were in some cases 2% or 3%. Or if you wanted a higher, say 4 or 5%, you're going to have to do a lot of work to the property, get tenants out of the property and raise the rents, all kinds of acrobatics to get the property to a point where you were generating a decent return. The good news is now there's all kinds of alternatives out there that are generating vastly higher returns than pretty much any of the real estate that I see here in Southern California. In fact, I've talked to several clients in the last couple of weeks that have investment property here in California, and as a result of the quickly rising costs and the limitations on how quickly they can raise rents, they're hurting. They, in many cases, own these properties, and the cash flow that they're receiving is minuscule compared to the asset value. And that's why I want to share this information with you. Now, importantly, I'm not a financial advisor. I'm not an accountant. I'm not a tax person. So speak to a professional before you make any investment decisions. I did want to just take a moment and let you know that my goal for this channel is to help as many people as possible obtain permanent housing security and build wealth through leveraging real estate and other assets that are available. And you can help me in doing that by making sure to like and subscribe. Leave a comment down below. Let me know if there's any content that might be helpful for me to provide for you, or if there's anything else that I can cover. And most importantly, if I can help you with any real estate needs here in Greater Los Angeles, reach out to me, let me know. All right, let's jump in. All right, so the first thing we should take a look at before we get started is the fact that right now, you can actually just buy a government bond, and the yield today on a 10-year government bond is almost 4.5%. Now, that is higher than the return that almost all of the people that I talk to are getting on their rental property here in California, or pretty much any rental property that you can buy today in Southern California. However, there is a caveat. If you did buy your property a long time ago for a much lower price, then you may have much higher returns than this. But if you bought your property in the last, 1, 2, 3, 4, 5 years, or you're considering buying your property today, this is a fantastic return compared to what you're likely going to get after all your expenses are said and done. Particularly if you have to get a loan, it's going to be impossible to buy a rental property, a multi-unit property, and do better than what you can do just by simply buying a government bond. Now, do I think that's a good idea? No, but that's a conversation for another video. So the first one I wanted to share with you is an ETF. The ticker symbol is DIV, and it's the Global X Super Dividend US ETF. Now, this ETF here is composed mostly of US-based companies, and here's kind of their top 10 holdings to give you an idea. Philip Morris, B&G Foods, Altria, Universal, Northwestern Energy, National Health Investors, etc. And the dividend yield here, which they're publishing on their site, they have a couple different metrics here that are measured differently, but more or less you're in that 6 to 7% range as far as dividend yield. Now, this is probably not going to be the type of investment you want if you're hoping for a lot of capital appreciation. Usually these high dividend paying ETFs like this, or stocks in general, don't really appreciate that much. They tend to have high dividend payout ratios. But if you're somebody that's looking for income, especially if you're looking for an alternative to real estate that you own here in California right now that isn't really generating you any money, and you're facing rising costs across the board on your property, or you're thinking about buying a property at these high prices that has very little return, this can be a wonderful option for you. But there's other options that generate way more yield than something like this. Now, this one here is broadly diversified across 50 different companies from all different sectors. But let's take a moment and let's look at what happens if you focus just on the real estate sector, which has been getting hit really hard because of the high interest rates that we've had over the last 2 or so years. So the next one I want to share with you is VanEck Mortgage REIT Income ETF. The ticker symbol on this one is MORT, MORT. I did share this one in a recent video of mine. I'll try to put a tag up here for you to take a look at that. But look at this. Even though the price has kind of rebounded quite a bit here in the last week or so, it still has a dividend yield of 13% trailing 12 months. Now, that's a pretty incredible return. This one here is kind of broadly diversified. Let's see, 69% in these 10 different holdings here. So you have quite a bit of diversification built in, but this one, of course, is focused particularly on the real estate industry. A lot of different types of REITs in the industry are combined into this one ETF to generate an extremely high return. And just in full transparency, I do own some of this one, and I have owned or will own some of these other ticker symbols, and I may buy and sell more of them in the future. So I just want to be transparent with you. We have another one here that I really like and I have owned in the past and I might buy more of if the price goes down further. This one is Invesco KBW Premium Yield Equity REIT ETF. KBWY is the ticker symbol. Now, this one has been trading down. Obviously, we've had these high rates for a while now, and this has certainly been very difficult for the commercial real estate sector. So a lot of these REITs and mortgage REITs have been hurting as a result of that. But look at the current dividend yield right here, trailing 12 months, 10.08%. I mean, this is incredible compared to a lot of these properties that I'm seeing here in Southern California that are yielding 2% or 2.5%, or in some cases even less than that, maybe 3%, 3.5% if you're very lucky. Now, here's a list of kind of the holdings here: Global Net Lease, Site Centers Corp, Brandywine Realty Trust, Peakstone, Global Medical REIT, Sabra Healthcare. So you could see this one is also fairly diversified across different REITs, and they combine them all up nicely and into an ETF that generates a very nice dividend yield. The last one I'll show you guys is REM, iShares Mortgage REIT Real Estate ETF. This one is pretty similar to KBWY that I showed you a moment ago. And look at this one, it's generating 9.82% dividend yield for the trailing 12 months. Obviously, this can fluctuate. It's always possible. A lot of these companies could go bankrupt. This can go down, or it's likely that it might just continue to rise slowly over time and continue to grow. But you could see here, you have a whole bunch of companies: Annaly Capital Management, Starwood, Blackstone, Rhythm Corporation. So a lot of these ones have overlap with each other, these real estate ETFs that I've shown you. But it really gives you an idea of what type of assets that are out there that you can buy that have very, very high yields compared to the typical rental property today, especially if you're in Southern California. So summing everything up, I just want to say that I have been very frustrated myself as an investor for several years now, because I feel like I've been stuck in an environment where all assets were extremely overvalued. Everything was extremely high risk, very low reward. And now I'm finally seeing a lot of opportunities that make a lot of sense to me as an investor with very, very high yields compared to what was available for a very long time. And it's that reason that I think it's important to share this information with you. Most of my clients and most of the people that I talk to aren't even aware that some of this stuff is out there. They really don't even know that it's possible to have these kinds of yields and to buy these types of assets that are able to generate this type of passive cash flow. So I hope this information was useful. I really appreciate you guys watching, and I look forward to seeing you on the next video. Take care.